Instead of just going to places where you are comfortable in, you go to places where the numbers made more sense. And that was kind of when I started to buy all these rental properties in Birmingham, Atlanta, Indianapolis. Probably not the coolest places to live. I've never lived there, right? But the cash flow is a lot better there.
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor! 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 Doctor!
Now, here's your host, Dr. 𝗪𝗚𝗍𝗍.
Physicians earn a strong income, but many of us eventually realize that a high income is not the same as financial freedom. Our income is still tied to our time, our shifts in the clinic or the hospital, our call schedule, and the number of patients that we see. Today, we're going to talk about how physicians can begin moving beyond that model by using passive real estate and alternative investments to build wealth outside of medicine. Welcome back to the Physicians and Properties Podcast, the show where we teach you how investing in real estate and entrepreneurship can give you the freedom to practice medicine and live life how you want. Today, I'm joined by Lane Kawaoka. Lane owns more than 10,000 rental properties and leads the Hui Deal Pipeline Club, which has participated in the acquisition of more than $2.1 billion in real estate through the syndication of over $200 million in private equity. He's also returned more than $45 million to investors through distributions. Lane has an incredible engineering background, and he uses that analytical mindset to reverse engineer the wealth building strategies that are used by high net worth investors, including many physicians. He also hosts the Wealth Elevator podcast, where he teaches working professionals how to build passive income and move towards financial freedom. Lane, thank you so much for joining us today, all the way from beautiful Hawaii. How are you doing?
Yeah, thanks for having me. Aloha, everybody.
Yeah, absolutely. I'm so glad to have you here. And before we get started into more, tactical investing strategies, do you mind taking us back to the beginning? How did an engineer from Hawaii go from buying his first rental property to owning more than 10,000 units and helping lead billions of dollars in real estate acquisitions?
Yeah, maybe similar path to a lot of people listening, right? We're all taught to go to school, study hard. I didn't want to go to grad school and get a doctorate, so I just Googled what were the highest degrees that got paid without, having to do that, and those are the engineering degrees. So that's what I set forth to do. The highest amount of pay with the least amount of effort, as I say. And I started to work for the man as a construction supervisor. And my parent, I always say people in my ecosystem were like first generation multimillionaires, right? My parents were never. They weren't accredited investors. They weren't landlords. In fact, very early on, they told me, don't rent your property out because your tenants will screw up your property. I think when I was 9 or something like that. So, but, kept on this dogma of buy a house to live in, work your white collar job. And luckily though, they taught us a lot of good money values. Don't waste things, don't buy frivolous things. And very early on, I didn't get paid multiple six figures, but I was still able to save 30, 40 grand a year. And I used that to buy a house to live in a couple of years after graduating college. Luckily or unluckily, how you see it, I was on a job where I had to travel all the time. I know some people do locums out there, right? Very similar. You're working on the road, you're a rambling man. And I had this big house to myself that I was only home on Saturday. And I just started to rent it out. And I was like, whoa, this is super cool, right? I was in my early 20s and this is a lot of free beer money. And then I got a little bit more sophisticated, started to buy a duplex a few years after. Again, this is just restricted by the 20% down payment, right? Me saving my money. But this is where I was able to save pretty much 100 grand every single year. And then the more and more rentals I got, the quicker I was able to save for down payment. So by the time 2015, I had 11 rental properties. And then that was kind of when I transitioned to syndications and private placements from there, when I became an accredited investor.
That's awesome. I want to stop you for just a second because I think something that you said is really important and pertinent to physicians, especially residents who are just getting started. You mentioned house hacking, or essentially house hacking while you're traveling and renting out your home. That can be such a great way for folks to get started, and that can look different depending on your scenario. For example, we still house hack part of our house. We have a separate basement apartment that pretty much pays for mortgage, taxes, and insurance for the year. And that way we're able to snowball more capital into more investments, and you can get the ball rolling much faster from that perspective by eliminating one of your largest expenses. So I wanted to highlight that from your journey, because you realized that really early on, and that led to the ability to save a lot more and snowball more and more of that money into those 15 units, which is really, really impressive.
Yeah, I mean, depends on where you're living, right? Like I was in Seattle, Washington, which like Hawaii, California, a lot of these more primary or sexier markets, you're not going to buy a property and rent it out anywhere near the 1% rent to value ratio. So you've got to kind of do a little bit more scrappier, buy a house and then rent out some rooms or get a split unit or quadplex. But, you eventually find, or at least, if you kind of notice, the first few units I was in was where I was living, Seattle, wanted to feel it, touch it. That's always natural, right? But the more and more sophisticated you get, you can do this more remotely, and you instead of just going to places where you are comfortable in, you go to places where the numbers made more sense. And that was kind of where the next generation went when I started to buy all these rental properties in Birmingham, Atlanta, Indianapolis. Probably not the coolest places to live. I've never lived there, right? But the cash flow is a lot better there.
Yeah, absolutely. And it's all about your goals, right? And I think that's really important to understand that you can invest in other places out of state, and it's not much more difficult, especially now, with Matterport and some of these walkthroughs you can do virtually of the homes and so forth. We have 8 residential assisted living homes. I've never seen any of them in person. And so there's a lot of ways that you can do that, and don't need to be afraid necessarily to invest out of state, but being in your own backyard and having that tangible asset that you can touch and see and get that exposure to initially can be really beneficial. Lane, when did you realize that owning individual rental properties was not going to be the final stage of your investing journey? Or maybe when did you realize that saving, buying a property was not going to get you to where your goals were?
Yeah, I mean, that's what they always tell you, right? Like you buy 5 or 10 properties, you pay them off, and then, you kind of snowflake that debt away. But, in reality, like with 11 rental properties, I'll just use myself as an example. I had maybe a few $100s per property coming in. I mean, a handful of the rentals lost money every single year, but on a totality, maybe $3,000 a month. Not bad, right? I mean, that's kind of like an extra paycheck for somebody a month. But, myself and a lot of my clients, you're looking more like $10,000 to $20,000 a month. And so just to give you a little insight, again, this is just my my data points, my experience share. With 11 rental properties, I had maybe an eviction or 2 every single year, some kind of big catastrophe that happened every quarter, like a tree falling in the house, a washout in the basement. Sure, I had professional property management to do all the dirty work for me, although I have to kind of babysit them, right? Because the property management in the residential real estate world isn't the greatest. But it was doable. But if you wanted 30 houses to get $10,000 a month, you're going to have to multiply the exception rate by 3. So now you're talking about an eviction every other month and some kind of catastrophe every 2 weeks that you get to play PM and manage the manager on. And you start to realize it's just not worth it. And then for me at the same time, it all kind of came together rather serendipitously. Like, this was kind of happening, and I'm kind of like still like, whatever. I'm just gonna keep doing it, right? Like, no pain, no gain, right? Like this is what it costs. The cost of making $3,000 a month. But I started to interact with other accredited investors, and this is like 10 years ago actually. I started to interact with other higher net worth doctors, engineers, like people that were several decades older than myself. More importantly, they had the same pedigree that I did. They had owned rental properties. Their net worth is maybe like $2 or $3 million, a little bit higher than mine's at the time. But I kind of respected them, right? Like, the last person you want to take a financial advice from is the guy in the cubicle next to you, or the guy who's been the resident, doctor for the last 40 years. Why the hell would you want to take financial advice from that dude, right? Think about that. But, they always like to spew their stuff, and they always like to, a lot of people like to get off on the ego thing, right, on giving financial advice. But I wanted to to me, success leaves clues. So I wanted to follow what these really wealthy people were doing, and the people that kind of resonated with me, who had not 11 homes like how I had, but like 30, 40. And what I realized getting to know these people personally is that these cats were selling off their rental property. And it's like, what? Like, isn't this what they are supposed to do? And what I realized was, when your net worth gets higher, and a big thing is legal liability, getting sued. So you've got a big target on your back when your net worth is higher. When, quite honestly, when I was younger, I didn't have an LLC set up quite yet, right? But I wasn't at a huge risk to getting sued because I was broke. What are you gonna do? Take my $500,000 away from me? But when you get above $1 million, certainly above $3-4 million, I think you want to start to be thinking more irrevocable trusts, more exotic strategies that go well beyond LLCs and the traditional stuff. But this is the discussions I were having from many, many people, and from just pulling these best practices together. I started to realize that a lot of these guys would go in as a passive investor to kind of get away from the management issues, but more importantly, the legal liability. I mean, I'm on the general partnership for thousands of properties, and at its peak, we're having like a drowning once or twice a year. It's very sad, right? And we got to go to the drill all the time, insurance and investigations, things like that. Don't get me started on like homicides where people aren't even living at the property this stuff happens to, right? And then we get drug into it. Of course, we're in the general partnership managing members, but this is something that a lot of passive investors never get exposures to. And why would they? They're just passive investors. And this is where I started to realize, okay, the legal liability, yeah, that really, really sucks. If you've never been sued, it's just a matter of time. And the frustrating part is if you're ever sued, even if it's so dumb, like people a bunch of gangbangers coming on your property and, offing one of their other guys, nobody lives there, you get pulled into it, you've got to pay like 50, 100 grand just to get the pure facts, the true facts out there to exonerate yourself. It's super frustrating. So, that's one side. But then now sure you guys talk about this a lot, right? But now you're getting access to higher quality institutional deals that you can, get a lot more diversification. Where the way I was going, I was kind of pulling all my rental properties together and getting bigger and bigger and bigger. And that definitely was not the way to go.
How would you like to build real estate cash flow without dealing with tenants, toilets, or late night maintenance calls? This episode is brought to you by Rent to Retirement. If you're a busy physician or professional who wants passive income and long-term wealth through real estate, Rent to Retirement has been helping investors do exactly that for over 15 years. They offer fully managed turnkey rental properties in some of the best markets in the country, including opportunities priced up to $40,000 below market value. Their properties have delivered average projected returns in the 15 to 20% annual range. And in some cases, you can get started with as little as 5% down. The best part is, these are often A-class properties generating $500 per month or more in passive income. And their team, they handle the heavy lifting, including property management. Thousands of investors have used this strategy to generate portfolios, creating over $10,000 per month in passive income. To learn more, click the link below in the show notes or visit renttoretirement.com. And be sure to check out episode 70 of the Physicians and Properties podcast, where I sat down with CEO Dr. Zach LeMaster to break it all down. Yeah, I think that's really important. And that economies of scale is so important where, like you mentioned, when you're having 15 homes and you're having all these headaches that happen with those 15 roofs and those 15 AC units and 15 hot water heaters, it's not as passive as people think that it may be. And, one new roof or one furnace that needs to be replaced can wipe out your entire cash flow for a year or more. And so it certainly can be helpful to think about, okay, what are some other strategies that can generate more significant cash flow or reduce my risk or be more passive, and kind of think through those strategies. And I think, a lot of the folks who listen to this podcast obviously are physicians who earn good incomes, but they still feel financially trapped because every dollar that they make depends on their ability to continually practice medicine. Why do you feel like so many high-income individuals appear wealthy but still struggle to achieve financial freedom?
I mean, perhaps the system is created to keep them working, right? I mean, to me, the system is, or the solution, I mean, it is like a simple triangle, like invest in alternative investments where you can cut through the middlemen and you don't go through the secondary market. I mean, we can talk about this later with my SpaceX stuff. Like that's a good example, but but then you get all these great tax benefits, like real estate, for example, passive activity losses, and you kind of run your taxes differently. So, very easily, like people can cut off like 10% of your tax bill, right, in the first year, kind of indoctrinating into this type of stuff. Some way more, right? A lot of people don't pay any taxes doing this stuff, right? It's all legal. And then they run it through an infinite banking plan. And it's just like this trifecta of strategies. When you do one of them, it kind of moves the needle. But when you move all three of them together, I think it's very, very powerful. And I've got a lot of doctor clients, and what's interesting about them is make high salaries, right? Just like my entrepreneur clients, right? The successful ones. It magnifies everything. You take most of my clients are above the age of 50 these days, and that. But yeah, most of my guys are above the age of, let's say, 55 years old. I would say if they're a doctor making multiple six figures, their net worth is like 1 to 2.5 million. And that's if they're good savers, right? Most of the people, they go through residency and they feel really behind, and everybody thinks there's this false expectation on the doctor, right? That they should be driving like a Porsche or something ridiculous like that. And then maybe they might get on the tracks, but then they'll get a divorce, right? I mean, that just happens all the time. But, a lot of times their net worth will be, like I said, 1 to 2.5 million, even if they're good savers. But if some people will come through and they're already in like a dozen plus syndication deals. They're already got like a good tax planner that's doing things like oil and gas deals. We could talk more about that. Intangible drilling costs, something to Google out there for everybody out there making over $400,000 adjusted gross income. And I'm not a tax attorney, by the way, that's a disclaimer. But if you need a referral, let me know. This is very common, right? And running it through infinite banking plan, and they're all net worths are like 4, 5, 6 million plus. So it's like night and day, right? It's like kind of like you take somebody who's just like a weekend warrior, they've got a gut, they're eating some things, might be doing some intermittent fasting once or twice a week, but you take a pure athlete that is like fine tuned, and it's just night and day, right? It's like, you're different, right? And the same thing, like you take the doctors that are indoctrinated into this trifecta of strategies versus not, or doing only one, it's night and day.
So I was going to say your platform, it's called the Wealth Elevator, and you describe wealth building as a progression rather than a single investment strategy. And you've alluded to that previously, talking about how, multiple things working in tandem can really help you perform like an elite athlete and not a weekend warrior. Lane, do you mind walking us through the Wealth Elevator? What are some of the major stages as an investor, as they typically move through his income, net worth, and experience, and as that increases over time? What does that look like?
Yeah, perfect. Yeah, let's just give away the goods that are in the book, the Wealth Elevator. So in the book, there's this construct of like these different floors, right? And as I've kind of told my story, I've kind of moved through these different floors one by one. And what I've realized is each floor requires a different strategy. What are you investing in? Look, I don't want to bad talk little rental properties, right? I want to make that very clear. And then you have some gurus out there trying to sell programs and, be a multifamily millionaire. Join my program, that's $50,000, right? After you come to my seminar, which they're all virtual these days because none of them work, But they try to tell people, why start with little rental properties when you can just buy big multifamily apartments, right? Like, to me, that's the silliest things. Like, I think at least from what I've seen and what I've seen how people fail, right? Especially going through those types of programs, is you got to kind of go up through a progression. But there are ways to kind of expedite your progression of these different floors. So maybe I'll just start by explaining like the different levels, right? The first level is like the basement level, right? Like, I don't think this is anybody listening, but this is the majority of wealth building dogma out there, the FIRE movement, the rich dad, poor dad world. These are folks that make under $50,000 a year. They don't have any net worth. Their net worth is under $100,000. I tell people, like, if you're in that category, just don't read the Wealth Elevator book. You're just going to get depressed. But there's so many other content like Dave Ramsey, Susie Orman. I mean, this is stuff I used to listen to in my teens. And I think they're great, right, for that type of world, right? Like, for example, you can do infinite banking with a little twist for, or prescriptive certain way for the lower net worth people trying to get out of their credit card debt, right, and pay off their mortgages. It's not super aligned with financial freedom and growing your net worth, which to me is the big piece of this, right? Net worth, don't lie. That's the score. But going back to the first floor of the wealth elevator, that's where I was in my 20s, buying little rental properties, and that was able to build the asset column and the experience to now be able to network to get into bigger deals and also evaluate bigger deals, whether as a general partner or a passive investor. And I think that you kind of get more into the credit investor space, so net worth $1 million or greater, or as defined as SEC, I think $200,000 a year of income or greater. But then the next level is the second floor, right? That's kind of that level, and then the next one is the third floor, which I kind of define as anywhere from $3 to $5 million net worth. The reason why there's such a big range is highly dependent on your personal burn rate. Some of my clients, family of 4, kids in their teens, haven't gone to college yet. They're gonna have a higher burn rate need, right? They might be spending 20, 30 grand per month. So they're gonna need maybe $5 to $6 million net worth to kind of get to this floor. Other folks, some people that live in a couple, older couple that lives in Alabama, their kids are already off to college, already, maybe not financially independent, but off of their payroll, and they may only need $2.5 million. Right. So that's where the range comes in. But at this point, you've kind of got the basics done, right? You've kind of got FU money in a way. I mean, you could probably put a lot of it in T-bills and life insurance and be okay, which is, I'm not a financial planner, right? But that's kind of what we talk about as the low risk, low return stuff. That's the brain dead investments that you could be doing out there. But rental properties are higher risk too, right? And so is value added real estate. So to me, you have to do that to grow your net worth. I don't think you can diversify your way to get there unless you just make a phenomenal salary. And some of you guys do out there. But I think if you want to expedite your way there, you have to kind of be on this razor's edge. I kind of made this mistake myself, right? I had 80 to 90% of my net worth into real estate and then commercial real estate. And then the big bubble popped in commercial real estate the last several years, and I got hurt really hard. And so I'm learning that I need to diversify. I have a pillar in commercial real estate, private credit, private equity, and then the really safe stuff, the T-bill-ish life insurance stuff is kind of the way I look at these 4 pillars today. But yeah, it's this idea of understanding where you're at, what floor you're at, and then the first floor, second floor, you're still in kind of growth mode. And then when you get into the third floor, fourth floor and higher, the penthouse, I think that's especially where you need a pure group of other purely passive accredited investors to be around.
Yeah, that's great. Yeah, I think there's certainly a period of time everyone's in wealth accumulation phase, and then you pivot over towards wealth preservation. Obviously, still want to accumulate over time, but that's where it gets more important. If you're retired and you want to just live off your investments, then of course preservation of capital is going to be a little bit more important to someone, say like me, who's in their 30s and wants to accumulate as much as possible. And everyone's risk tolerance is going to be different in what they want to invest in and what they want that journey to look like. So I think that's really important. Do you think that the you had mentioned you started with the 15 rentals and then pivoted more towards commercial. Do you think that there's a certain period in time where investor strategy should change? Because I kind of am a firm believer of shiny object syndrome is not necessarily a bad thing until you get to the point where there's something that you are really, really good at and you're making good money doing and you enjoy it, and then you go pivot to the next, red dress, if you will. And I kind of equate it to going to an ice cream shop, and initially you're just trying some free samples. That's the different asset classes. And then when you find the flavor that you really like, you pick that one and you stick with it over time. So I think there's certainly multiple arguments of does it make more sense to diversify really early on? Does it make more sense to try and accumulate as much as I can in one strategy and then diversify? What are your thoughts there?
Yeah, I mean, depends if you're a passive investor or you're a general partner, right? We're kind of on the general partner side, so we have to live and die and pick something. But, thinking more for the passive investor, what's kind of useful advice there? I mean, to me, when you're starting out, you have to, okay, I'm just going to call myself out on this. I got really freaking lucky when I started. I started at the right time, right? Like that's part of it. Just don't invest when the thing crashes. Duh, right? Like, I mean, I'm just pointing out the obvious, and like behind all interviews or talks, just don't hit the whammy, right? Don't invest in commercial real estate in 2022. You'll be okay, right? You'll probably do pretty damn good. That's like me, right? Like anything in real estate did well from 2009 to 2022, 23, right? I had a super bad strategy initially. I would just buy and hold. I would do no value add, right? But I was doing it in such a good time, I was able to cash flow, right? Look at the first several rental properties I had. And unfortunately, when I was buying those rental properties, if I bought that today, it'd be 140 grand per rental property. Today, when I was buying it, it was like 80, right? Duh, that's why you cash flow. That's why I look like a freaking genius, right? That's why.
Yeah, I mean, interest rates are so low.
It's not your grandpa's real estate game anymore.
Yeah.
So if you're looking for alpha, which is to kind of beat the standard quo, right? You have to be doing value add. And that's the aha moment that I had in 2016. I was like, yeah, I got really lucky. I invested in a great time, but what was happening in the previous macroeconomics is not going to be happening in the future. You have to be doing value add. You have to be bumping the rents, doing construction, or why we pivot to private equity today, buying businesses, right? You have to be doing to increase the net operating income in real estate or EBITDA, or the net income in a business, right? That's how you get the pop. That's how you sell it for a higher multiple later on. So that was why I pivoted to commercial real estate, because you're able to renovate units, and then we started to develop too, right? Multifamily. I think what we were lucky is like we could operate them, right? Because most developers cannot operate the asset. They build it and just want to unload it right away, because that's what they do, which is actually a good strategy for them. But I think that's the big thing. As an investor, you have to be going into things and not just buy and hope and pray. That strategy works in good times, but it works for that idiot in San Francisco, your neighbor, who buys his house and 6 months it's worth way higher. I don't know if that's the case these days, but that's market appreciation. That's dumb luck. There's two types of appreciation out there. There's that dumb luck market appreciation, and there's forced appreciation. Mm-hmm. Forced appreciation, I think a lot of people resonate who's listening. That's where you take fate in your own hands. You put in a lot of effort and work, and you increase how much money it makes, which in turn increases the value of it, which you can sell it for that. So you have to look for investments that do that. It's not just esoteric as buy assets, right? Well, buy assets that hold its value for somewhat, but assets that you can improve the value of it, right? And this kind of goes to the whole like mantra of, wealth comes to those people who create value. If you've kind of heard of this, I'm not a huge fan of just buying something and doing nothing to it. Like, that's why I don't do stocks, right? Like there's no really value creation there. You're just trading. Like you're just playing a stupid arbitrage game where, you're buying something on Alibaba and then you're doing it. Sure, there's some value creation there for distribution, but, true value comes to people who create value, and it's also repeatable, right? As opposed to like a one-trick pony. That type of distribution business just, comes and goes.
Yeah, well, in the control piece, right? Like you buy a stock, it's a piece of paper, but it's not like you're calling the CEO of that company and having any control in the decision that they make that may or may not increase the value of that stock. And when you own the real estate, when you are able to do that value add forced appreciation, you have a lot more control and a lot more ability to increase the equity or increase the amount of wealth that you can generate from that property. And so I feel the same way. That's why we love real estate so much, is because there's so many different levers to pull that are going to increase your net worth. And we haven't really talked about depreciation or the tax benefits or the amortization that's happening, the principal pay down by your tenants. And so there's so many different ways to make money in real estate that sometimes gets overlooked. Especially in the world where people are like, oh, we'll just put it in the S&P 500 and, maybe you'll get 10% over time, but they're not really looking at, okay, well, what about all these other levers that are pulled in real estate? And then, one of them, of course, being control.
Yeah. I mean, I do want to point out one thing. Recently I did the pre-IPO in SpaceX. I can't really say what exactly I got in. It's under 100, right? But I think it proves a point. And it kind of goes against my rule. Like I personally don't really feel like stock investing is adding value, right? 'Cause I guess they kind of are, but I think the biggest thing there is, I'll just kind of define some of these terms. Is like the difference between investing through the primary market versus secondary market. So, a lot of what we've been taught is to invest through the secondary market channels, right? When you get things from the big brokerage firms or mutual funds, even stocks, right? This is what Wall Street wants you to do because this is how Wall Street gets paid. So, and this is why I like investing either directly in a real estate property or directly with a syndication, right? Because they're essentially cutting out all the middlemen. And when you're doing this, you're accessing the investment through the primary market. So if you're following me, when you go through the retail market, you're going through the secondary market, or to hammer this home, that's sloppy seconds, right? This is where all your money is going away. And this is why, like my parents, they diligently put their money in the 401ks their entire lives, and they didn't really have too much to show for it at the end of the day, right? And this is why we're very early on, when I had a rental property, even though I wasn't doing value add to it, I was like, whoa, I'm making pretty good money on this because I cut out all the middlemen. And this is where on a syndication, right? Yeah, sure, you pay your 20%, 30% carry to your operator, but that's well worth it. You should see the carry interest on some of these other investments on the secondary market. So, when if I'm going to do anything, I want to try and get directly primary access because I'm going to get the wholesale price, if you want to think about it like that.
Yeah, absolutely. And that's massive when you're talking about, a pre-IPO price of SpaceX under $100. Today, it's at $186 per share. And so that's a massive return on investment and certainly, a unique scenario from that perspective. Let's talk a little bit, Lane, if you don't mind, about alternative investments. What are some alternative investments that you've seen the wealthy use to really jumpstart their journey, or things that you've seen that really have led to much more accumulation that's often overlooked for folks?
Yeah, I'm a real estate fan just like everybody else here. I love real estate. But because interest rates are probably going to be high for the next decade or two, right? Everybody should have the Chatham Financial Curve and the CME FedWatch tool bookmarked and checked out at least every quarter, saying that the interest rates are going to stay very elevated. And I think that's a big trade win to real estate. And we don't have that trade win anymore, right? So this has kind of forced me to kind of look elsewhere. And then also, again, just like in 2016, when I got access to a lot of real estate, rental property, accredited investors, now I look at my network, which are a lot of family offices, and how do they invest? And that's kind of where I'm like, hey, what are you guys doing? And what I've realized, just to crudely put it, there's kind of 4 big channels or pillars wealthy people will invest in. First is obviously real estate, right? We all know that. And I think that's allowed me to build a lot of relationships with people on this level. It's gotten me in the door. But they'll invest in things like private credit. So like on the debt side of deals, either whether that's real estate or businesses. The next one is private equity, right? This is very high risk, high return type of stuff, right? It may be a very, very small minority of your portfolio, but this is what allows them to create the returns to then be offset by that 4th category, which is your low risk, low return bucket that kind of creates cash flow. People are familiar with like life insurance. I think today like 4 or 5% there, T-bills, a little bit less than that. Also closed-end funds, if you want to get into that type of world, right? But these are essentially the four big buckets. They don't necessarily go into the average person portfolio. The asset allocation mix looks very different than somebody who has a lot of money, $10 million plus. But again, I'm not a financial planner. I've been told you can't talk about the asset allocation mix because they have all these laws where people are not licensed can't talk about this stuff. But then again, I say like, well, all the wealthy people I talk to, even $5 to $10 million net worth, their pie charts and what they're investing is all different all over the map. And so I think what I've kind of realized is people, as they're starting to get off of the beaten path of the traditional 60-40, stocks, bonds type of portfolio, maybe some international, like that's the standard cookie cutter investment model they want you to do because they make a lot of money off of that. But as you're starting to get off of this alternative investment world and into this world of a very weird pie chart, I think you need to get around other accredited investors so that you're just not operating as a silo on your own, right? It's hard enough finding deal flow But just kind of understanding like, how much alternatives do I want? Of the alternatives, how much do I want real estate? How much do I want private equity, right?
Yeah, absolutely. And that's going to differ for everybody, every stage of life, where they're coming from, all those sorts of things is really important. I want to pose a scenario for you, Lane, here as we get closer to wrapping up. But, a lot of folks who are here, obviously physicians, they probably earn, $300,000 per year or so. And let's say they have $150,000 to invest and they want to reduce the clinical work that they're doing over the next 10 years. So they're on their financial freedom journey. How would you encourage that physician to begin thinking about a financial freedom plan if they're just getting started? They've gone down the traditional, 401k path up until now.
Yeah, I mean, I would probably put in the metaphor of like, hey, you guys get a patient who comes in who's extremely overweight, metabolically deranged, and just like, what do you guys do? Most likely you probably give them a statin drug to bring their blood pressure down from 250 down to something more manageable, right? To me, that's synonymous with taxes, right? So triaging the taxes, getting them out of that 30% plus range first. Some methods for that, real estate, oil and gas, right? But then I think after that, once you've got them off of the, the watch list, I guess, right? I think at that point, you need to kind of start building that holistic investment portfolio. And part of that, maybe a portion of that would be real estate and other alternatives. But from what I've seen, we kind of watch people do this a lot of times. They'll start off with maybe 10% of their net worth into alternatives and kind of titrate up from there slowly as they feel more comfortable. Plus, part of that is like what I've learned personally, from this debacle of real estate these last several years is you never want to invest in just 1 or 2 years, right? You want to spread this out 4 to 7 years, right? Like I had a lot of losses, but I mean, I've been doing this for kind of a decade, right? Like I had deals that are still alive that have been in there and we're not going to sell them today, right? That'd be silly, but it allowed me to kind of balance out the losses and kind of stay afloat where, unfortunately some people that, they just happened to get started at the wrong time. In 2021, we didn't know, but we now know now. And some people play the armchair quarterback, but that was the peak of the market at that time. But to me, I come at it from more of like a modest standpoint where I'm like, look, I don't know when the peaks or the troughs of the market is. I'm not God. I don't have a crystal ball. Right. So what I'm going to do is just pick the best deal that comes up. I'm going to look at it. I'm going to operate I just cheat and I just look at how family offices do this. They get deal flow. So, and I'm going to do the same thing. So I get these deal flow coming in from people I like, I've worked with in the past, and I underwrite the deal. I take the P&Ls and the rent rolls. I don't look at anything on their pitch deck because that's all marketing schlop. I'm going to underwrite it with my reversion cap rate, exit cap rate. I'm going to use my expectations of what the rents will do. I may have to, backwards engineer some of the rent comps because I don't know exactly what that market is, but it's probably going to be a lot better than just taking what the operator says from face value. And I'm going to put it into my own spreadsheet and I'm going to run the deal. And I've never found a deal that's been overly conservative, but I just try to compare apples to apples and I, take these 4 or 5 deals and I'm like, okay, I don't know if this is the best deal plus or minus 6 months, but right now, this period of time, I like this one, so I'm going to do this one. And then 3 months later, I'm going to pick another one. And then 3 months later, I'm going to do that one. So that's the philosophy. And I tell everybody, like, I don't know if these are the best deals of all time. Nobody knows. But the idea is like, if you go out there and you pick the best one at that period of time and you've got this attitude, dollar cost averaging, and you never try to invest more than 5% of your net worth into any one deal, because that's how you get burned, I think you'll do over time. Sure, you'll suffer losses here or there, but I think this allows you to play the game, right?
Yeah, it's not a get rich quick scheme. It's get rich over time. Certainly, doing it well and doing it right can track that time frame. From like 40 years of a traditional person who's putting money in a 401k. Not a great way to do it. You can certainly track that down and get more towards financial freedom a lot quicker with these alternative investments and doing it well. It sounds like, kind of your strategy would be educate yourself, figure out how to decrease your tax liability.
Yeah, because that's kind of the risk-free return right there, right? Like investments have risks, don't get me wrong.
Right.
But if you can mitigate the taxes right up in front, at least we had some benefit there right off the bat.
Yeah, absolutely. And oftentimes that gets overlooked too, is the benefit, the tax benefits of real estate can get overlooked when you're kind of looking at what's the overall return profile look like. I tell folks all the time, don't invest in a deal just for the tax benefits. I think there's a lot of people out there who bought short-term rentals just for the short-term rental loophole, did not buy a fundamentally sound property, and they're losing a bunch of money. But hey, they have these tax benefits. That's not what we're saying here. It definitely takes.
Can I say something on that? Like, I'm not a huge fan of the short-term rental loophole thing. I mean, it works. Don't get me wrong, but you got to remember at some point you're gonna sell that property, and you got to pay back the piper on that.
Right.
And if anything sunk in, it's like the legal liability of this, and you don't want a freaking job, right? Yep. And we didn't get too much into like investment theses, but I like multifamily real estate because of the whole, like, the lower middle class is underserved. They're not making more of this stuff, and unfortunately, the rich are getting richer, and the middle class is becoming the lower middle class. Hopefully, they become apartment renters, but I think that's a long-term thesis, and the lower middle class is the population is growing. But I think that's where, you need to invest in things that have a long runway, a 10-year runway. And short-term rentals, they do really well when I think times are good, but when times are bad, it just gets totally blown up, or pandemics, right? People can't travel. So that's what makes me uncomfortable about that.
Yeah, agreed. There's definitely, risk certainly with that. I think, look at the lower middle class, that income gap is increasing between them and the wealthy. There's not enough affordable housing projects. There's not enough affordable housing units. That gap's going to continue to grow. The senior population, we're obviously big on assisted living. The baby boomer generation, there's 10,000 people turning 65 every day. There's 4,000 turning 85. Like, senior housing is a massive opportunity when you're looking at demographics with a long runway. So there's a lot of good opportunities there as well. Lane, I want to kind of wrap things up here with talking about kind of financial freedom and the impact that's had on your life. Because that's what folks are striving for mostly listening to this podcast, or I would say financial freedom, but really more so maybe time freedom is what people are looking for. Of how can I buy back some time? How can I maybe work some less shifts in the clinic, or not have to moonlight anymore, or get some more time to go to my kids' sporting events? So how has real estate, how has entrepreneurship impacted your life from a financial freedom perspective and allowed you to make decisions or spend your time the way you want to?
Yeah, well, it creates one problem for another. I mean, money's not everything, but it sure makes the life a lot easier. But it also creates problems, and just for the same thing, like, work with a lot of like entrepreneurs, or people here, like, people hit that finish line, they sell their business for 5 to 10 million, and yet they give up the keys to what gave them their ego. And I say that in a bad way, but in a good way, it's like what gives them fulfillment, right? So when you move from this mode of capital growth, capital accumulation, to allocating, some people get really excited about it. I've kind of made the transition smoothly, but a lot of people, they get divorced. They get a little bit lost because what gave them that notoriety, right? I'm not calling people out on this. I'm just kind of pointing it out. Like, if you're a doctor, maybe you like that attention, or being the person who on their worst day, you gave them some relief, or talk to them their, that worst dialogue that they're going to have. Maybe you like it because it's truly that human to human interaction. Maybe you like it because it makes you feel really good, or maybe you don't care about that. You just like the paycheck, right? There's something about this that you keep doing it. And, people who get to a high level, they're kind of kooky people, right? Like, I interact with a lot of CEOs in my peer groups, and we always admit we're kind of kooky people. There's something that makes us addicted to all of this. And, when there's some positive benefit, and I would say self-reflect on what that is, but you're going to lose that when you finally pull the pin. So some people, they're very well aware of this, and they're like, well, let me titrate up and kind of work part-time so I can keep getting my jollies going, but not totally burn out and still play with my kids at that time. But some people are not able to do that kind of stuff. Like, I know engineers aren't able to. You got to do the 40-hour work week or none. Entrepreneurs are kind of like that too, right? Like, we sell our business and we're done. but just something to kind of think about on the other side. But, I would still take that problem over, having to go to an office or having to work for somebody all the time.
Yeah, 100%. I think a lot gets talked about of like that journey to financial freedom or financial independence or whatever you want to call it. And then not as much as talked about, well, what happens when you get there? And
and that's where I think you need a peer group, right? Like, I mean, that's why we do our like in-person retreats and we have our community, because it's a lot of the stuff that's not talked about, right? Like every young guy on TikTok is talking about getting $5,000 of passive income, but first, that's not enough. You need more like 25,000. But once you get there, it's kind of like, hopefully you get there before you're like 55, 60, because I think some folks before, if you don't get there by 60, then you kind of mold your identity and your purpose to your job, whether it's true or not. Kind of like if you sprain your ankle and it goes a weird way, and it kind of just fuses that weird way. Like it's kind of that same effect.
Yeah, I agree. And I think, I think a lot of people love the idea of sipping Mai Tais on the beach and passive income coming in, and don't think about really, I think what we're after is the opportunity or the ability to go sip Mai Tais on the beach whenever you want. Like I know for myself personally, like I work part-time in medicine. I'm financially free, but I work part-time in medicine because I still love seeing patients. And I've been able to kind of titrate that, accordingly as income's gone up, or as, quote unquote, passive income and business income's gone up, because I still love to do that. And you're right. I think that folks are looking for, what does that look like going forward? And how can I do that smoothly? Because you're going to hit a point where it's that identity, especially as a physician, it's like the identity of the white coat and the stethoscope and, maybe some degree of respect and, the opportunity to take care of patients on their worst days. It's amazing. It's honorable. It's such a huge privilege to be able to do that. But I think having that freedom to practice medicine how you want to do it is what folks are really chasing after. And it's certainly possible to achieve that in a pretty significant or short time frame, as long as you do it right and do it well and have that mentorship and have that community to help back you and educate yourself and figure out what your goals are and what you want that to look like. And so I hope that some people got that out of this podcast. Like, hey, you just need to think differently than what we've been taught about, and the traditional path to retirement, if you will, can be altered. And those 4 pillars that you mentioned can be a really great way to do that. Lane, as we wrap things up, what's one piece of advice you'd give your younger self before purchasing your first property? What would that be?
I think that was all the right way to do it at the time. Don't buy 11, maybe just buy a few and then go into that more passive stuff. But yeah, like I said, it's all part of the journey. It's all, it's all in the wealth elevator, these different floors. So I'd say, pick up the book on Amazon. If you guys buy it, leave a nice review, send us a screenshot, and we'll hook you up. Screenshot team@thewealthelevator.com, and we'll hook you up with a free PDF. So if you're smart, you'll put into ChatGPT, ask it questions.
That's awesome.
Or if you're like me, you can't read too well, we'll send you the Audible or the MP3 version.
Awesome. Yeah, we'll be sure to include the links for the Wealth Elevator book in the show notes as well. If folks want to reach out to you, they want to work with you, they want to know more, is there a good place for them to reach out?
Credit investors, Lane@thewealthelevator.com. Yeah.
Awesome. That sounds great. Well, hey, thanks, Lane, for coming on the podcast. I really appreciate it. There was a lot of valuable information that was dropped here, a lot of valuable resources in the book as well. So I'd encourage folks to go get the Wealth Elevator book and reach out to Lane if you want to know more or potentially invest with him. So with that, it's been Lane and Alex with another episode of the Physicians and Properties podcast, signing off. Hey, real quick, if you're still listening to this, I'm assuming you got value from it. So I need your help specifically. My 2-year vision with this podcast is to help 100,000 physicians learn how investing in real estate can give you the freedom to practice medicine and live life how you want. There are 2 main ways that a podcast grows. One is through ratings and reviews, and the other is word of mouth. If you can please leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as send this to 1 to 2 friends that you think would get value from it, we can reach the physicians that we want to reach. Thanks in advance, and talk to you on the next episode. Please note that the information shared on this podcast is for informational purposes only. It should not be considered financial or medical advice. The views expressed on this podcast are those of the host and the guest and do not necessarily reflect the views of the Department of Defense or the United States Air Force.